Welcome to Intermediate Accounting. In this video, we're going to look at the multi-step income statement, or the income statements that are typically used, the format typically used by merchandising and manufacturing companies. Looks a lot different than our single-step income statement, which had all of the revenues together at the top and all of the expenses together immediately following the total revenues. Here we have several subtotals: gross profit, operating income, income before taxes, and net income. Let's take a look at each one of these items a little bit closer. Let's start off by looking at Amazon's net sales for the year ended December 31st, 2019, which were almost $281 billion. What does this relate to? Well, Amazon's sales of various types of nets, of course. We can see here's softball practice hitting nets, badminton and tennis nets, butterfly catching. What? It's not that type? Like after everything else has been accounted for? Oh, okay. Sorry, ignore that last slide. Net sales refers to the company's sales after we account for those other things that might reduce sales revenue. What would reduce sales revenue? Well, sales returns, sales allowances when the company provides a price break to its customers, and sales discounts that are given as incentives to credit customers to make payment to the company earlier than they might otherwise. Sales returns, sales allowances, and sales discounts are contra revenue accounts, and they all reduce sales revenue. So here's the question. Sales returns, sales allowances, and sales discounts carry what type of balance, debit or credit? Well, remember, sales revenues carries a credit balance. So if these items reduce revenues with a credit balance, therefore they must carry a debit balance. So while most income statements start with sales revenue, net, what's behind that net number? The gross sales, or the actual sales to customers, reduced by sales returns and allowances and sales discounts. Let's move along to cost of goods sold and gross profit. Let's take a look at an example here. This product that we're going to look at briefly is a baby nasal aspirator that's produced and sold by a company called Frida, also called Frida Baby. Now, this product is sold at Target for $19.99. Let's assume that that is Frida Company's sales price. Regardless of where it's being sold, it sells for $19.99. Let's now also assume that it costs Frida Baby $4.99 to produce one baby nasal aspirator. So what's the gross profit on every unit sold? Easy, it's $15. But if we take a closer look at what this product actually is, it's marketed as the snot sucker, and it can be used by a parent directly to remove any congestion from that baby's nose. I'd also like to point out that it has, at the time of this video, 8,410 ratings with almost a full 5-star review on Amazon. Now that is what I call a gross profit. Moving along, under gross profit, we subtract out selling expenses and administrative expenses in order to get to operating income. Selling expenses are all those costs the company incurs in order to try to market, promote, and sell its goods to its customers. Remember, it does not include the cost of production, but simply the cost to try to capture the customer's attention and get them to buy it. Administrative expenses are all those other operating expenses that are not cost of production and not cost of sales. They include all the costs that are incurred in that corporate office. When we subtract selling expenses and administrative expenses from the gross profit, we get our operating income. Below operating income, we subtract out other revenues and gains and other expenses and losses. At this point in the semester, we're only going to cover interest expense as one of the other items. Why do we subtract out interest expense? Why don't we just include it as part of our selling, general, and administrative expenses? Well, those are all operating expenses. Those selling, general, and administrative expenses are necessary to run the business. Interest interest expense, on the other hand, is a financing expense. It's the result of the company choosing to fund or finance its operations with debt as opposed to issuing shares of common stock. Remember, it's loans, notes payable, mortgage payable, bonds payable, that are generating the interest expense. And because it's simply that means of financing, we separate interest expense out and report it outside of operating income. When we take our operating income and subtract out interest expense, we get income before taxes. Of course, then we subtract out income tax expense and we reach our net income. Now I want to make one comment on closing entries. While closing entries are relatively the same as they are for any account, our contra revenue accounts are a little bit tricky. Remember, revenues carry credit balances, and our contra revenue accounts, sales returns, sales allowances, and sales discounts, carry debit balances. We need to keep that in mind when we're booking our closing entries. Since sales revenue has a credit balance, contra revenue accounts again have a debit balance. So when we want to close the accounts at the end of the period, do we need to record a debit or a credit to those contra revenue accounts? Of course, we're going to record credits to sales returns, sales allowance, and sales discounts in order to clear their balances with our closing entries. Let's take a look at a short example to conclude this video. Assume that Cardis Raris, a company that sells Ferraris, hear that the company might be splitting up in the near future, reported the following information at the end of the year. Sales are $800,000, returns and allowances are $24,000, and discounts are $15,000. Record the entries to close these accounts. Well, of course, sales is going to be debited to eliminate its balance of $800,000, and that amount is going to be transferred into the account income summary. And sales returns, allowances, and sales discounts, which carry debit balances, must be separately credited to reduce their balances to zero for the new accounting period. And of course, the offsetting debit to income summary is recorded. If you're wondering if these two entries can be booked together as one debit to sales revenue, two credits to sales returns, allowances, and sales discounts, and one net credit to income summary, you absolutely can. That concludes this video on the multi-step income statement.